The banks are hiding something, and I found the receipt. They called you crazy for buying silver. They called it dead money, a relic, a conspiracy trade for people who don't understand real investing. But this morning, COMEX released the one number silver bulls have waited years to see. And the same banks who mocked you, they just ran to the Federal Reserve, begging for $17 billion in emergency cash. Not because business is booming, because something inside the silver market is breaking. And today I'm going to show you exactly what broke, who's responsible, and what you need to do in the next 72 hours before this moves to the next phase. Stay with me, because this one goes deep. That number is 12,707. Now I know that sounds boring. Good. That's exactly why most people are going to miss what it means. So let me translate it for you right now. 12,707 contracts are standing for physical silver delivery. One contract equals 5,000 ounces. Multiply that out. 12,707 times 5,000. That's 63.5 million ounces of real silver. Not paper, not promises, not a digital number on a screen. Real, physical, metal. Let that sink in. 63.5 million ounces. Now let me turn that into normal language. Because I don't want you to nod at a number. I want you to feel what it means. Imagine COMEX like a giant warehouse, shelves stacked with silver. Now imagine thousands of customers suddenly showing up at the door, not browsing, not window shopping, demanding their silver today, all at once. 63.5 million ounces worth of customers. That's what 12,707 contracts means in the real world. And here's the number that makes it devastating. This single month's delivery demand equals 8% of everything the entire world mines in a full year. 1 month, one exchange, 8% of global annual supply. Let that sink in. That is not normal market behavior. That is a run on the bank. And the bank is running out of silver. So what happens when the warehouse runs low and the orders keep coming? Someone gets caught. At 8 a.m. this morning, the Federal Reserve's overnight repo window recorded a $17.251 billion liquidity spike. Now let me translate that. This was not a routine morning loan. This was not business as usual. This was Wall Street walking into the financial pawn shop, handing over their U.S. Treasury bonds as collateral, and begging for cash, because they didn't have enough of their own. Healthy banks do not do that. Strong banks borrow from each other. Weak banks, desperate banks, run to the Fed. So why did they need $17 billion before breakfast? Because the COMEX clearinghouse made the call. 3 words. Post the margin. The clearinghouse doesn't care about your strategy. It doesn't care if you think silver drops next week. It sees today's price, calculates your losses, and says pay up or we liquidate you. The banks looked at their books, and they didn't have it. That is the confession. That is the smoking gun. That is the body on the floor. But before we run the numbers, I need you to understand something personal. This is not just bank drama. This is your story. For 40 years the game was simple. Banks dump paper silver. Price drops. Retail investors panic. Sell at the bottom. Banks win. Repeat. But this time, the little guy didn't fold. The stackers kept stacking. The physical buyers kept buying. The working people they mocked stopped playing by their rules. And now Goliath is bleeding. The same institutions that called silver a pet rock are now pawning the family treasuries to survive the pet rock's revenge. Now let's do the math. And I promise I'll make it simple. One silver futures contract controls 5,000 ounces. Now let's say one major bank is short just 10,000 contracts. Conservative estimate. That's 50 million ounces they owe the market. Here's where it gets violent. If silver rises just $1, that bank loses $50 million. Not over a year, not over a quarter. Right now, in real time, $1 move, $50 million gone. Now, silver didn't move $1 yesterday. It moved $5, $50 million times 5, $250 million lost. One bank, one day, before they finish their morning coffee. Let that sink in. That is not volatility. That is a financial gunshot wound. Now multiply that across every major bullion bank simultaneously. We're talking billions in losses, accumulating in real time, with no exit door. And margin calls don't wait for hope. They don't wait for spin. Cash is due now. Wait, it gets worse. Because the Fed's solution is actually the trap. The banks need cash because silver is rising. So the Fed injects cash. But printing more cash weakens the dollar. A weaker dollar pushes silver higher, which means the banks need more cash. So the Fed prints more. Do you see it? They are trying to extinguish a fire by pouring gasoline on it. Every dollar they print to save the silver shorts is another reason silver has to rise. This is like trying to save a sinking boat by drilling another hole in the bottom. The rescue is feeding the disaster. And mathematically, there is no exit from this loop. At $77 silver, They needed $17 billion. At $85, they'll need $30 billion. At $100, the repo market itself starts to seize. We have seen this movie before. September 2019, repo rates spiked, Fed panicked. Months later, unlimited liquidity. Same pattern, different trigger. This time the trigger is silver. Now zoom out, way out. This morning's COMEX number was not just seen by traders in New York. It was seen by analysts in Beijing. It was studied in Moscow. It was reported inside BRICS economic councils before most Americans had their first coffee. And here's the dangerous part. When America's rivals see the Fed quietly wiring $17 billion into the system to protect bullion banks, they don't get scared. They get strategic. Because Shanghai is not telling the same story as New York. COMEX trades paper confidence. Shanghai trades physical urgency. And right now, physical silver in Asia is trading at a premium above the Western paper price. That gap is the real market speaking. That gap says, we don't trust the paper number. We want the metal. And when that distrust spreads, when the rest of the world starts asking if New York has claims but not the silver to back them, money starts moving east, fast. That is how old financial orders collapse. Not with a press conference, not with an announcement, with a gap between what paper says and what physical costs. We are watching that gap open in real time. If you know someone who still thinks silver is just a metal trade, send them this video, because this has turned into a monetary story now. And monetary stories move generational wealth. And this is the part one want every silver holder to hear directly. You were right, not approximately right, not partially right, completely, probably, undeniably right. You were right to distrust the paper market. You were right to question the pricing. You were right to hold through the ridicule. They laughed because they believed the system would hold forever. The $17 billion spike says it won't. The 63.5 million ounce delivery demand says it won't. The fleeing shorts say it won't. They mocked silver as a relic, then they sprinted to the Federal Reserve when the relic started demanding delivery. You held the line. They leveraged themselves into oblivion, and now the bill has come due. Okay, here's what you do in the next 72 hours, and I need you to understand something before I give you these steps. This is not just a global market story. This is about your savings, your purchasing power, your ability to protect what you worked for. The next 72 hours could be your last window to act before this enters the next phase. Step 1. Watch COMEX registered inventory, not total silver. Registered silver. That is the metal actually available for delivery. Think of it like the gas gauge in your car. You don't care how much oil exists underground, you care what's in your tank right now. If registered inventory keeps falling while delivery demand stays this high, the pressure becomes a crisis. Check the CME Daily Vault report every morning. Step 2. Watch for the paper smash. The banks just received fresh emergency cash. That means they may attempt one final scare tactic next week. A sudden violent drop in the paper price. If that happens, do not panic. Do not confuse the paper price with physical reality. A wounded system always thrashes before it breaks. If they slam the paper price next week, that's not strength, that's desperation. Watch the premium at coin dealers. Watch physical availability. If paper drops but physical premiums stay high, the real market is still screaming shortage. The screen price is a lie. The street price is the truth. Step 3. If you plan to buy physical silver, do not wait for perfect conditions, because in a shortage, perfect conditions are the first thing to disappear, not the price, availability. The moment COMEX officially fails to deliver on even one contract, the buy button vanishes, and you will not get a warning. Let me leave you with this. For 40 years, the banks controlled the silver story with paper. They sold contracts they couldn't fill. They printed promises they couldn't keep. They built a machine designed to make you doubt real money and trust their system. Today, the physical market answered back. 12,707 contracts, 63.5 million ounces, $17.251 billion in emergency cash before 9 a.m. These are not random numbers. They are warning flares. They are the fingerprints of a market moving from suppression to stress to break. And most people still think this is just another commodity move. They still don't see the system cracking underneath it. But you do now. And in my next video, there is something inside the Shanghai data, something I found this week, that is even bigger than today's $17 billion story. I'm not going to tell you what it is here, but I will tell you this. The banks are terrified of this chart getting out, and you will only see it if your notifications are on. Subscribe right now, turn on notifications, because what's coming in the next video makes today look like a warm-up. I'm John. This is JonFunds AG, and the squeeze has only just begun.